here in a minute, and then if she joins us, we can add her to the list. So let's be called to order at 4:03 p.m. and let's run through the roll. I am Bob Stevenson, Chairman.
Jackie Lowe.
Yep, Finance Director Jackie Lowe.
Jim?
Board Member Jim Phelps.
Okay.
Rita Russell, Council Member at Large.
Victoria?
Victoria McDermott, I'm the Deputy City Attorney.
Great. Then I guess Wendy and Brett.
Great. Wendy Dominguez from Innovest, and I'd like to introduce my colleague Brett, who you haven't met yet, but Brett is helping me on this account. So I'd like to have him introduce himself.
Yeah, thank you for that, Wendy. And like Wendy said, my name is Brett Minnick. I'm a Vice President Consultant here with Innovest, and I will be helping Wendy and Stephen moving forward with the plans. So very, very excited to be a part of this relationship and look forward to working with all of you.
Great. And Paul, did we get you?
Good afternoon. I'm here. Yes.
And your name and relationship to us?
Yes. Paul Wood with Gabriel Roeder Smith. I am your actuary. So
Great.
I do your actuarial evaluation reports.
Great. Well, since I don't do this every month, it all helps to remind me, if nothing else. For the members, did everybody get a chance to look at the minutes? And are there any questions on there? Or if not, I would entertain a motion to approve them as submitted.
We've got Belinda present and absent.
Belinda was present, I
Is
believe.
showing up as present
Yeah.
and absent.
Huh. I didn't catch that.
Yeah, another question, it seems Gabriel Roeder Smith and Company was not present in May, if I'm not mistaken.
Paul, did you have a colleague attend in your absence? I can't remember.
I thought we
You know what?
had somebody here.
Might have been Christy.
Christy, I think she.
Yeah,
she
I'm drawing a
was
blank
here.
if I was there or not, but yeah, Christy was probably there. Yes.
I remember we just had a short report because there wasn't much of concern. But I do remember having somebody represent you guys. And I thought Belinda was here at that point. Do you remember, Rita?
I think Belinda was here. She may have come late, and maybe that's why it's counted in both places.
Yeah, that would make sense. I think she did check in. So with those addendums, thanks, Jim.
So with that correction, I move that this be approved.
And
Do I
also,
have it? Go ahead.
also Shelley Fritz is here now, so
Oh, there's Shelley.
Sorry, we were having technical difficulties with the computer from City Hall to Malley, back to Malley. Sorry about that.
I knew there was somebody else missing. Good to see you. So Shelley Fritz is now here. Would you like to second the approval of the minutes?
Sure, I will.
Thank you. All in favor of approval, say aye.
I,
Hi.
Aye. Motion is
Aye.
carried. Okay, unanimously now. Do we have any new business? I'm not aware of any, Sean,
No, there's no new business to discuss.
that I know of. Okay. Do we have any public comment? Seeing no members here, I guess
And
we don't.
nobody submitted any.
Okay. So we are now down to a report from Gabriel Roeder Smith and Company. And that, I believe, is Paul.
Thank you very much, Mr. Chair. My report will be brief again today. This is typically the meeting that we would present the actual evaluation results, but we are still waiting on some data items. So we have not been able to complete it yet. So our hope is to continue to work with staff and get those necessary data items for the evaluation, and then at the next board meeting to present those results, because it's going to be pretty important. We need to know, let the city know what the contribution rates are going to be. And so, like I said, I'm confident that we'll get the data hopefully very soon and be able to complete our report. But that is all I have for today.
Yeah, Paul, this is Jackie Lowe. We may
Jackie.
need the information a little bit earlier for budgeting purposes. Is it possible if you have information you could email us, then we can dive into the details in the November board meeting?
Yeah, absolutely. I think the problem still is that we don't have sufficient data to actually run the valuation. So we are at a standstill right now, waiting for that information to come to us.
Okay.
So if anyone's in position to, to spur that along, that would be very helpful. But at this point, we've certainly Christy has spent an exorbitant amount of time trying to get this information. So,
so
Where
as
is
soon as,
that?
but Jackie, we won't wait. I'll tell you what, we won't wait for the November board meeting. Once we have the report done, and I'll send you an update when we get the data, and we'll keep it moving in that regard. But
Great.
just like I said, there's not
So,
much more we
Paul?
can do on our end. Yes.
Paul, where does the
Yes.
information come from
Um,
that you're
I think
waiting
this
on?
is- Yeah, this is part of the challenge, is that it seems like there's it comes from a few different sources. There's no longer it doesn't feel like there's a centralized source. So Christy has been in contact with a few different people in the city there, in the HR department, and then the benefits folks, and I think there's been some turnover, so it's been a little bit more difficult to get that information this year than in
So-
the past.
Okay, so Sean, I know that Sean is in the meeting. Were you aware of that? That they're waiting
Yeah,
on
no,
it?
I was not aware of that. Paul, if you could reach out directly to me and
Will do.
And then, Paul, when you get that, would you also copy that to members of the commission?
Absolutely.
Okay, great.
All right. Thank you.
Thank you. And I think that takes care of that. Do we have any retirements that we need to approve? I guess, Sean, you would know that, right?
correct. I don't have any to present.
Okay. I have not heard of anybody. Okay. And so now On to Wendy and Brett for Innovest. Thank you.
Great. Thank you, Bob. Brett, are we able to share our screen?
Yes, we should be able to. Give me one moment.
Perfect. Well, great. Well, I will start us off and then Brett's going to get into more detail about the investments in the plan. But if you would maybe go to the first page, Brett, just wanted to highlight a few things happening in Innovest. We've, as many of you are probably dealing with too, we've had a lot of promotions and some new faces at Innovest. We're now at 56 employees and added 3 new partners. So we've been continuing to grow, continuing to give back to the community. We've highlighted a few of our local community events. We typically do actually 1 per month. And if there's ever opportunities in the city for us to help, we'd love that opportunity. But we typically use it as not only a great way to give back, but to build our teams. So on the next page, next couple of pages, if we just stop on 2021, we have made a few updates to the portfolio, as you know, in the last couple of months or few months. Towards the end of 2021, we were actually able to diversify the portfolio into some new asset classes, which in hindsight have done a tremendous job in protecting the portfolio. We've added allocations to hedge funds, to other real assets, to private equity. All of those things have performed exceptionally well in the current market environment that we're in, which, as you know, has been very difficult. So that timing was very fortunate and fortuitous in hindsight. Although, it's never great to come to meetings like this with negative performance. We hate it. In particular, we will be showing you some relatively performance that is negative, but relative to benchmarks, it's done well. And again, some of the diversifiers that we've added have really helped hold up the portfolio value. Most recent quarter down almost 9%, and we'll put that in context. S&P 500 is down 20, bonds are down 10. So in that environment, to be down 9 isn't great, but it's not as bad as it could be. Those are actually year-to-date numbers. Year-to-date, you're down 12, which again, we hate coming with negative performance. But again, in this backdrop, it's held up better. A diversified portfolio, and your portfolio in particular has held up well. Since inception, if you go all the way back to 1987, you're annualizing at a 7.14% return. Again, those are pretty spectacular returns over a long period of time, even considering the most recent quarter and year-to-date period. So if we, that's kind of a sneak peek at what Brett will talk about later, but just and to put it into some context, and unfortunately, Jackie and Sean have heard my spiel before, so I'm sorry to bore you with more of that same presentation, but I think it helps put some context around the markets, and we're seeing them. So if you look at the core fixed income markets, you can see down 10% year to date. 1 year is also down 10.3%. That is the worst 6-month start of any year that we've ever had in history. So it's historic bond markets. You couple that with really bad equity markets, and if you look at the S&P 500, year to date down 20, that's the 3rd worst start of the S&P 500 in history. So you put those two things together, and a balanced portfolio suddenly doesn't look very good. And that's the kind of the environment that we're up against. On the next page, as to why that's happening, there's a couple of reasons. One is the Fed is aggressively fighting inflation, and because of that has aggressively increased interest rates. And if you look at some of the leading economic indicators, which the market is one, those are continuing to come down from the highs of 2021. On the next page, if you look at, again, what the Fed is trying to do, Fed is trying to curb inflation by reducing money supply. And they've done that with a couple of metrics, a couple of tools. They've increased interest rates dramatically over the past 6 months, 75 basis points in each of the last 2 monthly meetings, as well as not reinvesting some of the bonds that they hold in their assets. That's kind of the reverse of quantitative easing that we've seen historically. So the chart on the upper right shows that the money supply has come screeching to a screeching halt. In fact, if you look at real money supply, that's well below zero. So the Fed has done what it's trying to do, again, controlling the money supply to reduce inflation. We still haven't seen it make its way into the inflation numbers yet. But if the bond market, if the expectations for inflation for long term are in that 2.5% to 3% range. So what, typically the bond market is known as the smart money on Wall Street, and the expectations from the bond market are for inflation to come under control. So hopefully that's the case, and hopefully we can get inflation numbers to come back down, but that's really impacting markets. On the next page, this is one of my favorite charts in this book. It looks at consumer sentiment, which is currently at a 50-year low. And I think that's important because if you think about when times other sentiment has been negative, like the beginning of COVID, way back in 2008 with the financial crisis, you look at the stock markets in negative territory in 2001, 2002, 2003, 1990. Some of those areas we see very negative sentiment. And there's a saying on Wall Street to be greedy when others are fearful and to be fearful when others are greedy. So this consumer sentiment number, to me at least, communicates that fear that others in the market in general are pretty fearful. And if you look historically at what the subsequent 12-month returns are, once the sentiment trough is hit, it's pretty positive. It's actually about 25% annualized return in the S&P 500 in the subsequent 12 months after a consumer sentiment low. So I think that's pretty interesting and maybe hopeful for the fact that the markets are trying to look forward. Maybe the markets believe that the Fed is going to engineer a soft landing, that inflation will be in control, and markets will continue to climb on. On the next page, part of maybe the positive that the markets are seeing is that on the bottom chart, household debt service ratios are relatively reasonable, even though we've seen a big increase in the interest rates on revolving debt and car loans and mortgages for that matter. But we're still not seeing it make its way into a much, much higher. It's rising, but it's not a much, much higher household debt service ratio. I think the upper chart is interesting too, through government stimulus and the fact that people just didn't spend their money during COVID. The cumulative excess savings in consumer savings accounts was at 2.26 trillion. So that has only been drawn down by 0.24 trillion since the beginning of 2022. So that again bodes well for consumers having to navigate potentially, if we are in a recession, some challenging times with hopefully have some pent up savings. On the next page, valuations in this environment look attractive. I guess that's the benefit of prices falling. Valuations are less, and typically when you buy stocks, when valuations are cheap, the subsequent 5 to 10 year period for stocks is positive. So that's why it's important to look at valuations. And in every case, except for China, US, Japan, Europe, and emerging markets are well below the historical or 25-year average. So that bodes well for stocks going forward as well. On the next page, this is, I think, an interesting chart because it looks at the difference in time horizon and how big of an impact that has on investment returns. And the longer time period you have, the less volatility there is around those numbers. So if you look at the 1 year period, investing in stocks, you could have anywhere from a plus 47 to a minus 38. That's historically since 1950, the experience that you would have had. If you had a 20-year holding period, though, the amount of variation is very, very low. And in fact, nothing it's not negative in that time period. So that again tells you the importance of holding period. And I think the quote on the top of this chart is one of my favorites as well. Over a decade-long time horizons, your investment performance will mainly be derived from how you handle corrections, bear markets, and market crashes. And I think that's a nice reminder in the market that we're in right now. On the next page, I think this paints an important context as well, and you've actually seen this in your performance if you look at how you've navigated these markets. The year to date, the quarter, the 1 year, this is a heat map, so the brighter the red, the worse the performance, the brighter the green, the better the performance. So quarter, year to date, 1 year, dismal performance, double-digit losses across almost every single asset class over that time period. However, if you look at 3, 5, and 10, which include the most recent 1 year period, you still see double-digit in many equity sectors, double-digit returns. So that's, again, an importance about, this has been a really rough 1 year period, but 3 year, 5 year, 10-year performance is still relatively strong. And then one last thing before I turn it over to Brett to walk through your specific investment performance. This is looking at the sector. So every sector in the second quarter was negative. The least worst performer was consumer staples, down 4.6. Consumer discretionary was the worst, down 26% in the quarter. So that's a pretty big pullback in a single quarter in a single sector. Still, though, over 1 year periods, energy is way outperforming everyone else, up 40% over the 1 year period. So any questions on any of that before I turn it over to Brett?
Wendy, do you know why communication services was doing so poorly in the past year?
I think if I had to guess, and maybe Brett knows better than I do, but technology and communication services tend to use a lot of debt financing to grow, to invest in new to new programs or infrastructure, and with interest rates increasing, I think that's what is really affecting their stock price. Brett, do you have any other thoughts there?
No, not necessarily. I think that's very well said. I think it's a similar reason as to why consumer discretionary is down so much. However, with consumer discretionary, right, it's individuals and households that are no longer purchasing these goods. Thus, the companies that are growing are not going to be able to grow at the same rate. For information technology and communication services, it's businesses that are no longer and large organizations that are no longer placing that much investment in those types of goods and services, and therefore kind of the tightening of the money supply, like Wendy had referenced, is being felt in really not a positive way, helping aid those negative returns.
Yeah, because I was thinking if people are working from home, they totally depend upon internet. Why would communication service sector their stock price drop so significantly? Yeah.
Yeah, I think a lot of the investment and the investment in people working from home actually happened in early 21 and late, or actually just 2021 probably. So I think some of that spending, the projection of that future spending, as Brett mentioned, is a lot less.
Yeah, thank you.
All right, so with that, unless there are any other questions, I'm going to go ahead and just move forward a bit to the actual portfolio itself. And I'll start briefly on these first couple of pages. So page 16 is the investment policy summary, all as of the most recent date, so June 30th. And this is just simply a recap of the strategic allocation in every asset class that the portfolio has exposure to. So you can see the name of all the investments on the right-hand side and their allocation on the left-hand side. And just as a reminder, at a very high level, the portfolio is approximately 51% stocks, 20% bonds, and about 29% those alternative asset classes. And we'll get into it, but like Wendy said, those alternative asset classes, the real estates, hedge funds, and other real assets were very, very strong contributors to the portfolio over the last quarter. On page 17, we just wanted to analyze, as of June 30th, how does the portfolio allocation actually look versus the target? And as you can probably expect, on the bottom right-hand side here, you'll see that those asset classes that performed the worst in the quarter, so if you think domestic and international stocks, they're a little bit underweight, while the better performing sectors, real estate and some of the other diversifying asset classes, are a little bit overweight. So the portfolio is allocated as we would expect given performance over the last quarter and even year to date. And then with that, taking a look at the manager scorecard itself, despite all of this market volatility, the scorecard for the underlying funds is actually fairly clean. There are only 3 minor concerns on all of the products, and only one of which is new this quarter. And in our opinion, that's a good sign. The first is a minor concern in the people category for that Thornburg International Fund. And there was a fairly quick departure at the portfolio manager level that took place in early last year, and that warranted the downgrade at the time. However, our assumption would be it's been over a year at this point since that departure took place, and unless anything else were to happen at the portfolio manager or that decision maker investment direction level, we would expect that this concern would actually roll off for next quarter, so that every single category for that fund would actually be green. Also in the people category, there's a new minor concern for the Eaton Vance floating rate fund, and they also had a portfolio manager step down. However, it was just in this most recent quarter. The good news is that was part of a fairly lengthy succession plan. And additionally, Eaton Vance actually brought on 2 additional portfolio managers to help manage the load and mitigate key man risks so that there's not just one key decision maker driving the investment direction of the fund. And as a result, we absolutely wanted to call that out on this scorecard, thus the minor concern. However, we do not necessarily expect any changes in the philosophy or process of that strategy. And then finally, we have another minor concern that carried over from last quarter on the Harding-Loevner Emerging Markets Fund. And really, this concern is a bit unique in the sense that near-term performance has really impacted long-term returns. I'll actually go down to the table of returns to express this here. And we're looking at the fund at the very bottom of the page on page 20. So coming into the year, this Harding-Loevner fund had almost 9% direct exposure to Russian equities. And when the conflict occurred, they had to essentially write down all of this exposure to a value of 0. And as a result, they are lagging their average peer by more than 6% year to date, which has sort of distorted their long-term performance. You can see it converges a little bit more towards the peer average as we look further to the right on this page. Because of this near-term performance hindrance and actually what was fairly strong last quarter relative to some of its peers in the benchmark, we do not recommend changing this fund. However, we will continue to monitor and diligence the fund and keep it essentially on watch. And then really the last thing that I wanted to share is that this past quarter and year have been a challenging one for just about all of the managers in the portfolio, and that is probably to say the least. If you look at performance over the last quarter, there are some fairly large negative numbers. The Dodge and Cox stock fund is down north of 12%, placing it in the 66th percentile of its peers. And the Harbor Capital Appreciation Fund, this is another example, down about 25.5% last quarter, more than 35% year to date. And that places it somewhere between the 90th and 91st percentile when compared to the peers. But like Wendy mentioned when she was going through some of the slides there, and one of the last slides she touched on talked about the volatility if we have a short-term time horizon, but how those returns historically have tended to smooth out over time. If we look at the right-hand side of this table of returns, and this holds true for this page and the following investments, you'll find that 11 of the 16 managers included within the portfolio that are actually compared to their peer group, so this includes a lot of the public equity and fixed income managers, are actually top quartile performers, so better than 25% when compared to their peers over a 10-year time horizon. And the 5 that are not actually top quartile performers are fairly close. So if we look at Harbor Capital Appreciation, for example, they're in the 27th percentile. And the same can be said about the American Funds Euro-Pacific Growth Fund, as well as, if I go to the next page here, the DFA Emerging Markets Fund at the top, also in the 27th percentile compared to peers. So this is why we really do believe that disciplined approach and long-term emphasis, and really why we would not recommend any strategy changes to the underlying investment managers within the portfolio. And then like Wendy referenced, I do just want to quickly touch on some of the diversifying strategies. Really one of the few, if not the only places that you'll see last quarter and year-to-date positive returns. Real estate, a very, very strong contributor to that and that downside protection of the portfolio. And then finally, if I skip on down to this last page, you can see that other real assets, so these are typically things like farmland, timberland, and even oil and gas infrastructure type funds. Year to date, one of the few with positive returns, as they are generally linked to inflation. But with that, I will leave it on this page here just because we've got the total fund performance relative to the benchmark. And you can see in the last quarter, just to reiterate Wendy's point, performance was negative. However, relative to the custom benchmark to the portfolio, actually there was a bit of outperformance, once again, just relative, and that tends to hold true through longer term time horizons as well. So with that, that's really all that I have for planned remarks. Are there any questions about what I've covered?
Yeah, Brett, we did quite a few changes last year based on board directive. So if we take a look at those new products we added to our portfolio in mid-2021 and or December, could you go over the performance of those newer funds? Because some are in a, I think, private equity sector. So could you go over those funds we added later last year?
Yeah, and I'll provide a little background from the Innovest point of view as well. So as we go through the pandemic, we see this dramatic sell-off in public markets, so your stocks and your bonds, as well as in your private markets. So there was ample opportunity in spaces like private equity, hedge funds, things along those lines. So that kind of prompted internally an evaluation of a lot of the portfolios that we help consult to. And then ultimately what resulted in the implementation of a few of those types of strategies. My understanding, and Wendy, you can tell me if I'm wrong here, is that those strategies, so this would be the, excuse me, I'll scroll up here, the IMGP alternative strategy, the low correlated hedge fund, and then Ironwood were implemented mid to late 2021. So if we look over the last year or so, this is probably going to be the most, the closest approximation since they've been included in the portfolio. And actually, if you see on the right-hand side, we've got this since client inception column, which is going to be since these funds were actually incorporated into the portfolio, the month that they were incorporated, we've started measuring performance. So what you'll note really across the board with all of those types of private market and diversifying asset classes is that in some instances, there has been a negative return since they have been implemented into the portfolio. So for example, that IMGP hedge fund down about 8.25% since it was incorporated into the portfolio, and the Ironwood hedge fund down about 1.5%. However, it's really important to keep in mind that beforehand, it may have just been exposure to some of the more traditional asset classes, which over that time are down double digits, 10+%, even 20% in some instances. So the role of these types of strategies in a lot of instances is not necessarily to obtain the largest return and contribute to the highest upside within the portfolio, but to diversify risk. And really outside of the Tortoise MLP and Pipeline Fund, which had tremendous growth since it was put into the portfolio, they have done exactly that.
Yeah, thank you, Brett. Also under private equity, Partners Group Private Equity, we don't have the rate of return for that particular product, but we did have a benchmark. So could you help us understand why we don't have the rate of return for that particular product?
Yeah, and that's a fantastic question. So when you're talking about these private market funds, information just simply isn't as attainable at times as some of the other mutual funds. For example, the Dodge and Cox funds, you could go onto Morningstar or Google the ticker and find performance. These alternative strategies don't necessarily have the same legal requirements, so obtaining that information can be a little bit more difficult at times. However, I do want to point out that for that Partners Group fund, generally speaking, their returns are lagged by about, I'll call it, about a month or so. And then we just received the June 30th performance for that specific fund, with the report being prepared before that moment. They were not incorporated within the report itself. But know that quarter to date, the Partners Group Private Equity Fund was down about 6.1%, and that brings year-to-date performance to negative 5.1%. Now, it's tough to say what that would look like since inception. However, it would be close to the year-to-date number.
Okay. Another question is, if I remember correctly, we're trying to sell our shares with the Stonebridge reinsurance risk, right? It seems we still have $194,000 left in that account. So what is the strategy to sell out the balance?
Yeah, another really good question. So with these, this probably goes for reinsurance, private equity, hedge funds. A lot of the times it's not as easy as just simply pressing sell on a Schwab account and having it go through at market close. Oftentimes there's what they call put queues, and the asset manager, so in this case Stonebridge, is actually the one who allows or permits distributions from the fund as to retain the integrity of the portfolio for those investors remaining within the strategy. So what has been happening on a quarterly basis, Innovest is filing paperwork with Stonebridge to redeem as much of the exposure there. So as of 6/30, the almost $200,000 as possible. They then come back to us and allow for a certain percentage to be sold out. So for example, they will say, yes, based on your request, we can redeem 25% of the shares that you are requesting to be redeemed. And then that will take place. Those funds will be allocated elsewhere within the portfolio. And then the next quarter, Innovest will again file the same paperwork. So unfortunately, this plan is not the only investor redeeming from the strategy. So they have enacted a little bit stricter provisions to get out.
Yeah, Thank you. But the funny thing is they're doing well last quarter and for last year. So might be unintended consequence or our passive strategy.
Yep, no, and then we obviously recognize that as well. Year to date, they are positive, which cannot be said about every other asset class. However, at the time of when we presented information to actually divest from that strategy, we believe that the issues were more structural within the industry as a whole, and then a lack of confidence within that specific manager. Therefore, we believe those are a little bit long-term issues as opposed to shorter-term performance gains. So we do still stand by and retain conviction in divesting and getting our money out of the Stone Ridge reinsurance product.
Okay. I do have additional questions, but I want to leave the opportunities for other board members.
You're doing fine, Jackie.
Oh, okay. If you don't mind, can we go to page 16 of the PDF file? It's our investment policy summary. We adopted this in 2021. Our goal is to get 6% for our actuarial purposes. Could you help me understand the risk tolerances? Except downside -15 to -18. Is that our, just like rate of return, we have a goal, and in a downturn, our risk tolerance level is between -15.5% to 18.5%?
Exactly. No, that's another fantastic question, Jackie. So when Innovest models portfolios, we look at two things: expected return, and probably more so importantly, downside risk metrics.
I agree.
What we try to do is model out that information over a 5 to 10 year time horizon, because estimating single year returns, as you've seen over the last 6 months, is very, very, very challenging. So what those numbers mean is those are 95% confidence interval and a 99% confidence interval. So what we would expect is that 1 in every 20 years, the market conditions, should they be poor enough, would result in this portfolio losing approximately no more than 15.5%. The larger number, the 18.5%, that's actually the 99% confidence interval. So that's going to state 1 every 100 years, we would expect downside of 18.5% or an 18.5% loss in a 1 year period. Does that make sense?
Yeah. Thank you. Also, could you help us understand under the performance benchmarks, we have an investment manager, primary index, and a peer group universe. Could you help us understand the purpose of these 3 benchmarks?
Mm-hmm. Yeah, of course. And a lot of that has to do, really with 2 things. Number 1 is evaluating performance. I know Wendy, Stephen, and probably some other folks have had plenty of conversations about, fiduciary duty to not necessarily be an expert in the underlying investments, but to continue to monitor and diligence them. So that's why we show information for both the indexes and the peer group universe. So the index, we want to understand, especially for active managers, whether or not their goal is going to be to outperform their index. So we want to understand whether or not they are actually executing on that goal. And for passive managers, so for example, the Vanguard 500 index, the goal of that portfolio is to simply track the performance of the index. And by comparing relative returns for the 2, we're able to understand whether or not they're actually doing that. And then the peer group universe is another way to evaluate relative performance. We want to understand, and I'll just use Dodge & Cox stock as an example since it's at the top of this list. We want to understand, even though this is an active manager, and let's say they are outperforming their benchmark, the S&P 500 Value Index, are there more consistent, stronger performers in the universe? So that's why the peer group universe is included in there. You will notice at the bottom of the page, there are some NAs or not applicables for some of the private market investments. So hedge funds, other real assets, and private equity. And that's just simply because in a lot of those instances, I should say, peer group universe information is not necessarily existent. It's very, very challenging to find, and oftentimes the information is so lagged that it's not beneficial to evaluate performance and attribution.
Okay, thank you. So what is our next step with this kind of environment with new products? So what is the next step for our portfolio?
Yeah, I would say, and Wendy, please feel free to chime in here as well. At this very moment, we are not recommending any changes to the strategic allocation nor to the underlying investments. However, as a part of our regular process, later in the year, we will be conducting, essentially asset allocation analysis to understand, given how market conditions have changed and how they will continue to evolve, do we, and this is both parties on this phone call, believe that the portfolio is still strategically positioned to meet our risk return metrics or requirements. With that, we will bring information. Should there be proposed changes, we'll bring information on that. And as far as investment products go, it is very challenging to say. However, should we believe that there is a need to include another investment manager, whether incorporate a new asset class or change an existing investment manager, we will always bring that information to the group directly.
Yeah, I think I completely agree, Brett. And I think that, as we look forward, fixed income is much more attractive than it has been historically. We can get now a 3-4% yield out of the bond portion of the portfolio on a forward basis. That's much more attractive than it has been for years. So there might be a potential as we go through the asset allocation process that Brett talked about, that we can even maybe reduce the risk of the portfolio in order to still try to obtain that 6% return through utilizing more fixed income type investments. But, we've added inflation hedges to the portfolio, so that's helping protect in this inflationary environment. We've minimized the duration on the fixed income to try to control the interest rate risk. There's really only about 15% of the portfolio currently in traditional fixed income. So, on a go-forward basis, and that potentially could increase slightly. So, we think the portfolio is actually in a good position. Again, we hate coming and telling you that your portfolio lost money, but, relative to how it could have been. And then also, this is only through June. July was incredibly strong. I would imagine your portfolio might be up 3% in the month of July. So 3 to 4%. So, all of that hopefully bodes well for the rest of the year.
Thank you.
So, Mr. Chairman, that's all that we have today.
Thank you. I appreciate it. And I appreciate your questions, Jackie, because that's a lot of that is over my head. But as you talk about it, I'm starting to get a bigger picture. I think we're on the same page that we just need to keep on trucking and hope that we can, the economy will turn around. I see quite a bit of that happening. We just have to stay the course and continue to do what we're doing, I think, and let the game come to us, so to speak. I don't know of any old business, and are there any board members who have anything that they might want to introduce?
Bob?
Yes.
This is Rita Russell, and I just, the one thing that I wanted to bring up, I did finally get a response from Belinda Porter, and I remember her sharing when the council interviewed her was that 4:30 would be a better time frame than 4 o'clock. Or 4 o'clock was a little bit difficult. So I don't know if the board could consider, or if there would be problems with the two groups that come to share if we change the time to 4:30.
Do I have any input on that? Does that matter to Wendy? You're shaking your head. No, that doesn't matter. Does that conflict with anybody else? Sean, you might have to stay a little late.
It's fine. It's once a quarter.
And also Paul.
Yeah, this is Paul. That's fine. Yeah, we can make whatever time you want your meetings to work. We're here for that.
Okay. I would entertain a motion that we meet at 4:30. And oh yeah, Jackie, you're on staff too, so that would make a little later. But I will entertain a motion and would recommend that we start meeting at 4:30.
Did you make the motion?
I can't make a motion.
Okay, I'll make the motion.
Do I have a second?
I'll second.
Is that Shelley?
I think Jim Phelps is seconding the motion also. He's on
Okay.
mute, so. I was
We'll
trying to
say
get him off mute, but I can't get him off mute, sorry. Trying.
We'll say Jim seconded it. Let's say all in favor. If there's no more discussion, all in favor, say aye.
Aye.
Aye. I believe the motion is carried unanimously. Okay. We will meet next November the 8th at 4:30 p.m. Great.
Can I ask a question?
Yeah.
So Jackie, is there any reason that the board needs the information from the actuarial report before?
I think this is for my budgeting purposes. I think we need to know the contribution for the new year, the city's. Yeah. And I'm also very interested in learning, because last year, based on actuarial report, based on our assets liabilities, unfunded liabilities, it would take the city 14 years to pay off all our liability. I'm just very curious about after a year, what the number looks like.
Okay.
But this board wouldn't necessarily have to take action on that before it came to council.
No.
No.
Okay, thank you.
This would just be informational, and I would just like the board to be apprised of where we stand too, if we can find that out.
Yes.
And with that, I will entertain a motion to adjourn.
I move to adjourn the meeting.
And I'm in favor, so that ends it, right? Thank you all. This has been most beneficial. Appreciate it. Bye-bye.
Thank you, everyone.
Thank you. Bye.
Bye-bye.